Good morning, Monday, March the 6th, and this is your mortgage moment for the week. On Wednesday is the highlight of the week, and that will be the Bank of Canada's meeting to assess the overnight rate, amongst other things. The consensus is that the rate will stay flat, although last week I had a bit of concern that it might not, and there was just a little bit more indecision on a lot of segments and points that impact the market. Bond yields rose a little bit at the beginning of the week but fell back down, so we started this week about 2 basis points behind where we were last week. So we continue with the wait and see and the fixed rates, although a couple of lenders did bump up the rate a little bit last week. Nothing significant. Things are pretty flat overall. I wanted to mention a couple of things on product and rate, but there's lots of rates advertised in the markets, and generally people will advertise the lowest rate available. 9 times out of 10, if not more, that rate that is advertised is likely an insured rate. And when we deal with insured rates and low rates, it's usually from a monoline lender. Monoline lenders are all insured. They're not one of the big five, if you will. They're not a big retail banking organization. They just focus on mortgages. They all have their products have to be insured. So when you have an insured mortgage through a monoline lender, you have to pay, as the borrower, the premium, the insurance premium on that. And that insurance premium will basically cover the lender should you default on that mortgage. So there is a cost involved, but the borrower bears the brunt of all of that cost, therefore giving the lender a little bit more assurance and allowing them to reduce that rate a bit more. So it's more or less, return, risk and reward. There's very low risk with an insured mortgage, therefore there's a little less cost to it. We moved from insured, we moved to insurable, and that is essentially the same, except the lender will cover the insurance premium. And there's lots of pieces in there that have to be measured. Credit score is the biggest, the loan to value is the other one, and then income and property overall is another big key there. So the insurable mortgages are those that have more than 20% down payment. They must fall within $1 million in value, and they must be owner occupied. There's a few other pieces in there as well, but I won't delve into all the components. Then we have the uninsurable basket, and the uninsurable basket is that property that is priced at over $1 million, maybe a rental. It's greater than 25-year amortization, and those rates are generally significantly higher. And just a quick look this morning, the low end with one lender is just under 5, and then for that uninsurable mortgage, it's closer to 5.7. So there's a bit of a spread there for sure. So just to keep that in mind when you're talking to clients and they say, well, I see the rates in the market are this versus that. Just keep in mind that there's a lot of variables there that need to be considered before confirming whether that is indeed the mortgage that that person wants to receive. So leave you with that for the week, and there's a bit of blue sky behind me here. I hope that we get a couple more days of this and we push those double-digit temperatures, and we can all shake off the shorts and get out and enjoy ourselves. Have a great week. Bye for now.